Have you heard about HELOCs or home equity lines of credit and you're wondering why you may want one? There are some great reasons to get a HELOC, but there's also some major pitfalls and little known things you'll want to be aware of. In today's lesson here, what I want to do is go in depth on HELOCs with you, what they are, how they work, the advantages and the disadvantages, so you can make the best move on your next home financing decision.
Maybe you can explain what a HELOC is and what makes it different, let's say, than a regular mortgage loan that most people are familiar with.
So what a HELOC stands for is home equity line of credit. It is like a credit card on your house. It's a line of credit that uses the equity in your home as collateral. So there's a lot of different benefits that we'll talk about of why HELOCs are so in demand and so hot right now. But one of the coolest things about a HELOC versus a regular mortgage is that a HELOC is considered an open-end loan. So what an open-end loan means is that money can go in and out freely. So you can put money in and you can take it out the next day.
But there's got to be some main advantages of using a HELOC to borrow.
Yeah, so I would say the number one reason people love HELOCs is because the interest rates are low. Like most lending on a mortgage or a home, it's going to be a lower rate than a personal loan. It's going to be way lower than a credit card or any other type of loan that you can get because it's secured by the equity in your home. The next thing is the flexibility of a HELOC is unbelievable. So that's a huge thing. The other is liquidity. Another great benefit is tax deductibility. This has changed recently because of the tax code that changed, but there's still, for most Americans, is tax deductibility with a HELOC, specifically if you're using that HELOC to improve your home. And then the last thing I'll say is the fees on a HELOC. They're typically very low. There's even some HELOCs I've seen that offer no fees.
Share with us some of the downfalls of a HELOC.
Yeah. So number one reason that a HELOC has risk is because it's an adjustable rate. So it's not going to be a fixed rate like you have on your normal first mortgage. Another huge negative on a HELOC is that it's not a long-term instrument. You're not going to have a HELOC for 30 years like a regular mortgage. Typically, a HELOC is going to have a 10-year draw period. Last thing's going to be credit score. HELOCs are going to have tougher qualifications, higher credit score requirements.
All right, so then what's the difference, let's say, between a HELOC and a cash-out refi?
A HELOC is normally going to be a second position mortgage. The other thing is that a cash-out refi is going to incorporate your existing first mortgage. So if you have an outstanding balance on a mortgage right now, when you do a cash-out refi, we're going to take the existing balance and we're going to add money to it, the cash out that you need, to create the new mortgage loan, to create the new amount. Like I've mentioned already, the qualifications for a HELOC are going to be harder than a cash-out refi. So if you have lower credit, cash-out refi may be a more suitable option for you. Also, a cash-out refi has way more flexibility when it comes to debt-to-income ratios. There's a lot of different options for cash-out refi loan types. You've got FHA, VA, conventional, non-QM, all these different options. HELOC, it's the only game in town. Last but not least is the closing costs. Cash-out refi is going to have your regular closing costs that you have on any mortgage, setting up your escrow account if you're including tax and insurance, paying recording fees, of course, title insurance, attorney's costs, loan origination charges, processing fees, etc.
How can a HELOC be used to pay off your home early?
Gist of it is you use your HELOC as a checking account. So as money comes in, instead of leaving it in your checking account earning you nothing, you put it all into your HELOC. Then it pays down the balance. And the way a HELOC works, it calculates interest daily instead of monthly. So by having a lower balance, it lowers your average daily, which means that your interest is lower. So another way you can use a HELOC to pay off your first mortgage early is by making periodic transfers from your HELOC to your first mortgage. The other great thing you could do with a HELOC, but is to use that HELOC to pay off high interest debt like loans or credit cards, and then use the money that you're saving per month to then pay down your mortgage. I hope now you have clarity and education about what HELOCs are and when they should be best used. If you found value in our lesson today, go ahead, hit that subscribe button, also smash the bell so you get notified on all of our future content. Please share this with somebody else who may find value in it as well. I'd love to hear from you, so hit the comments, let us know what you're liking, what other content you'd like to see. We're putting out tons of more information and education every single week on the channel. If I can be of assistance to you or anyone that you know, I do offer consultations. You can reach me by call or text at 860-413-3938. Again, I hope that helps, and we'll see you soon. Take care.